Good evening, everyone. Tyler's off tonight. Call it the tortoise rally. The Dow crawled to a new high, its fourth record in as many days, and it's reaching the milestones at a painstakingly slow pace. Today, it rose by a mere 2.5 points. The S&P 500 took a breather after 4 straight days of historic closing highs and slipped by a fraction. The blue chip Dow average is just points away from the new milestone of 17,000, and S&P 2000 is also pretty close. The Nasdaq added nearly 2 points, but these puny gains and losses are a far cry from the summer tradition of dramatic rallies. Our guest tonight says this slow grind higher in stocks is actually a good thing. He's Jim Paulson, Chief Investment Strategist at Wells Capital Management. So, Jim, tell us why that slow and steady like a tortoise is actually a good thing for the markets.
Well, I think, Susie, that it doesn't, as long as it goes up slowly, it doesn't bring out the worst investment behaviors. I think if it starts to run, people panic, they start to chase it, they start making decisions too quickly and too aggressively to not miss out. And I think in a slower moving market, it lends itself to greater rationality, which is really it makes the market more self-sustaining. So far, that's kind of what we've got, and I think it probably has further to go, and we're probably going to see a little bit of the irrational movements before this thing finally does correct.
But what's really holding back investors? I mean, what's worrying them? We know that earnings are doing better. We know that the Federal Reserve is going to keep pumping money into this market, keeping interest rates low. Why are they holding back?
Well, I think, there's a great legacy of the '08 crisis, Susie, that just hangs on the investment mindsets, I think, and has really been long-lasting, longer than past recessions, where there's still a great memory that, boy, of how bad that was going through that, and people are still hesitant, even though this market continues to go up. And actually, that might be a good thing. Like I say, that keeps people on their best behavior, and that's the type of thing that keeps this going. I think in addition to that, people are worried about what was it with bond yields falling recently? What did that suggest? Is there panic in the European Union that they have to come out more aggressively and ease even more? Does that mean Europe is in trouble again? Is China bottoming out or not? There's still plenty of issues to worry about. But I think for most investors, if most are still worried, that's a good sign.
All right. And as we make these small advances towards new milestones, what stocks are going to lead the way? I mean, so far we've seen some not so exciting sectors like utilities being the big performers. Are we going to see more of that, or who's going to lead the way?
Well, I've been thinking we could get up around this 2,000 area since year end. But I also think we might have a more difficult second half, Susie. I think bond yields are going to climb here in the second half of the year, above 3% towards 3.5%, maybe giving some difficulty for stocks as well. So one thing I don't want to go to bonds heavily, but within the stock market, I think I would sort of diversify between a couple more cyclical, economic sensitive sectors and a couple defensive sectors. So on the cyclical side, I still really like technology. I think we're at the front end of a capital spending cycle, which is just beginning, going to benefit that. And I like materials because I think as the year continues to progress, we're going to see more inflation evidence, and that's an inflation hedge. On the defensive side, if stocks start to stumble a little bit, I do like the utility stocks, and I like the consumer staples for the defensive sort of steady Eddie character that those possess. Right now, may not be super attractive, but if the market starts to get more volatile, they will become more attractive.
Real quickly, because we have half a minute, what about bonds? A number of market pros have been saying for some time now, stay away from treasuries. Where do you stand on that in a few words?
Yeah, I would be underweighted there. I think the biggest damage coming here over the rest of this year, in the next couple of years, is going to be in bonds. I really think the 10-year Treasury might reach 3.5% or more before the year's out. So I would definitely stay underweight.
All right, Jim, thank you so much for coming on. Always a pleasure talking with you.
You bet.
Jim Paulson from Wells Capital Management.